In 1345, a single signature on a piece of parchment destroyed the richest financial empire in medieval Europe and triggered an economic collapse that lasted 50 years. One king's refusal to pay his debts didn't just bankrupt a bank, it shattered the entire foundation of international finance and sent Europe spiraling into its darkest economic period since the fall of Rome. The Bardi Bank of Florence controlled more wealth than entire kingdoms. Their credit network stretched from London to Constantinople, financing everything from wool shipments to crusade armies. They were medieval Europe's equivalent of Goldman Sachs, JP Morgan, and the Federal Reserve combined. When they collapsed, they took down not just competing banks, but entire nations' economies. But here's what nobody knows. This wasn't just about one bad loan. The Bardi had been playing a financial game so dangerous, so unprecedented, that when it finally exploded, it created economic destruction on a scale that wouldn't be seen again until the Great Depression. They had essentially invented modern banking and accidentally discovered how modern banking could destroy civilization. Think about this. In 1340, the Bardi Bank was handling more international transactions than most countries' entire treasuries. They had pioneered credit systems, international lending, and currency exchange that made them indispensable to kings, merchants, and entire economies. Their financial innovations were 5 centuries ahead of their time. Edward III of England owed them what would be $2 billion in today's money. When he defaulted, it didn't just hurt the Bardi, it triggered a cascade of failures that destroyed the Peruzzi Bank, the Acciaiuoli Bank, and dozens of smaller financial institutions across Europe. Entire cities lost their economic foundations. Trade networks that had taken centuries to build vanished overnight. The most powerful merchant families in Europe, dynasties that had accumulated wealth for generations, were reduced to poverty in months. International commerce ground to a halt because nobody trusted anyone else's credit. It was medieval Europe's first truly systemic financial crisis, and it nearly destroyed capitalism before capitalism had even been invented. This is the story of how medieval bankers accidentally created instruments of mass financial destruction, how they built a credit system so interconnected that one default could crash the entire European economy, and how their collapse changed the nature of money, banking, and international finance forever. You think 2008 was bad? You're about to discover the financial apocalypse that makes modern banking crises look like minor hiccups. Giovanni de Bardi died in 1340, thinking he was the most successful banker in history. His family's financial empire spanned 3 continents, controlled international wool markets, and held the debts of kings and emperors. The Bardi Bank's marble palaces in Florence were filled with gold, silver, and precious documents representing credits worth millions of florins. 5 years later, his sons were begging for food in the streets of Florence, while angry mobs burned the Bardi palaces and demanded blood payment for the life savings that had vanished when Europe's greatest bank collapsed overnight. Today, economists study the Bardi collapse as the first recorded example of systemic financial risk, the moment when medieval Europe learned that banking innovations designed to create wealth could also destroy it on an unprecedented scale. The mathematical models that analyze modern financial crises trace their intellectual origins back to scholars trying to understand what happened in Florence between 1343 and 1346. Yet the Bardi story begins not with financial sophistication, but with sheep. Specifically English sheep whose wool was so superior to any other fiber in Europe that it became the foundation for the most advanced credit system the medieval world had ever seen. You see, around 1250, Florentine merchants discovered that English wool, when processed using Italian textile techniques, created cloth so valuable that it could support international trade networks spanning thousands of miles. But accessing this wool required enormous capital investments, loans to English wool producers, advance payments to shepherds, transportation costs across dangerous trade routes, and currency exchanges between dozens of different monetary systems. What most people don't know is that the Bardi family didn't start as bankers. They were wool merchants who developed banking services because medieval commerce was so risky and complex that someone had to invent new financial instruments just to make international trade possible. Behind their success was a revolutionary insight. Instead of physically moving gold and silver across Europe to pay for goods, they could create credit systems that allowed merchants to trade using written promises backed by their reputation for reliability. This wasn't just convenient, it was transformative. Suddenly, commerce could move at the speed of written communication rather than the speed of armed caravans carrying heavy coins. The bardi pioneered what we now call letters of credit, international banking networks and currency hedging, financial innovations that were centuries ahead of their time. They created the first truly multinational corporation with offices in London, Paris, Naples, Constantinople, and dozens of other commercial centers. But their greatest innovation was also their deadliest. They figured out how to lend money to kings. Royal loans offered enormous profits because monarchs could pledge entire kingdoms' tax revenues as collateral. The problem was that kings, unlike merchants, couldn't be sued, imprisoned, or forced to pay their debts through normal legal mechanisms. This created what modern economists call moral hazard, when one party in a financial transaction can take enormous risks because someone else bears the consequences of failure. Kings could borrow vast sums knowing that bankruptcy would hurt their creditors far more than it would hurt royal treasuries. The bardi understood this risk, but the profits were too tempting to resist. Royal loans paid interest rates of 40 to 60% annually, returns so enormous that they could transform successful merchants into wealthy aristocrats within a single generation. By 1340, the bardi had lent so much money to European monarchs that they effectively controlled the credit that financed international warfare, trade policy, and economic development. Here's what's fascinating. The bardi weren't just bankers. They were the architects of medieval Europe's transition from a primitive barter economy to a sophisticated credit-based financial system. They invented accounting methods, developed insurance contracts, and created international law frameworks that made complex commercial relationships possible across different legal jurisdictions. Their success attracted imitators and competitors who copied their innovations while trying to steal their most profitable clients. The Peruzzi Bank, the Acciaiuoli Bank, and dozens of smaller institutions all adopted similar business models based on international lending and royal credit. Competition drove all of these banks to take increasingly dangerous risks in pursuit of the enormous profits that royal loans could generate. But what nobody understood, not the bankers, not the kings, not the merchants who depended on this system, was that they had accidentally created Europe's first systemically interconnected financial network. Banks lent money to each other, guaranteed each other's credits, and shared risks through partnerships that seemed to spread danger, but actually concentrated it. When one major bank failed, it would trigger cascading failures throughout the entire system because every institution was connected to every other institution through layers of mutual obligation that nobody fully understood. They had built a financial house of cards without realizing that it was a house of cards. The crisis began not with the bardi bank, but with events that seemed completely unrelated to banking. A war between England and France that required massive military financing, weather disruptions that devastated agricultural production, and political instability that made long-term commercial planning impossible. Let me take you back to the moment when medieval Europe's most successful banking family made the decision that would destroy their empire and trigger the first international financial crisis in European history. Chapter 1. Wool Gold. The fortune that would eventually destroy medieval Europe began with a 13-year-old boy standing in a muddy English field, watching sheep graze in the rain. Riccardo de' Bardi had sailed from Florence to the Cotswolds in 1263, carrying his family's life savings, 47 gold florins, and a desperate plan to break into the wool trade that was making other Florentine merchants wealthy beyond imagination. You see, English wool in the 13th century wasn't just a commodity. It was medieval Europe's equivalent of crude oil. The sheep that grazed in English pastures produced fleece so superior to continental European wool that it commanded premium prices from textile manufacturers across the Mediterranean. Florentine weavers could transform English wool into cloth worth 10 times the original fleece value. But accessing that wool required navigating trade networks that were controlled by established merchant families with generations of experience. young Ricardo understood something that would reshape international commerce. The real profits weren't in buying and selling wool. They were in financing the entire production cycle, from sheep to finished textiles. English wool producers needed advance payments to fund their operations. Flemish weavers needed credit to purchase raw materials. Italian merchants needed loans to transport goods across dangerous trade routes. Someone who could provide financial services at every stage of this process would earn profits from multiple sources while building unbreakable relationships with all the key players. But implementing this strategy required capital that the Bardi family didn't have, and financial expertise that didn't exist anywhere in Europe. Medieval commerce operated on simple cash transactions or basic barter systems. The sophisticated credit arrangements that Ricardo envisioned would require inventing new forms of contracts, developing international law frameworks, and creating accounting methods that could track complex multi-party obligations across different currencies and legal jurisdictions. Here's what's fascinating. Ricardo wasn't trying to invent modern banking, he was just trying to solve practical problems that made international wool trading nearly impossible using existing financial tools. But his solutions accidentally created innovations that were centuries ahead of their time. The breakthrough came when Ricardo realized that English wool producers faced seasonal cash flow problems that created opportunities for creative financing. Shepherds needed money in spring to pay workers and maintain flocks, but wool sales didn't generate revenue until autumn shearing. Traditional moneylenders charged interest rates of 100–200% for short-term loans, making profitable sheep farming nearly impossible. Ricardo offered a different arrangement. Instead of lending money at usurious interest rates, he would advance cash to wool producers in exchange for exclusive purchasing rights at predetermined prices. This gave shepherds the capital they needed while guaranteeing Ricardo access to premium wool at below-market rates. Look, this wasn't just clever trading. It was the invention of futures contracts 5 centuries before commodity markets made such arrangements commonplace. Ricardo was essentially buying wool that didn't exist yet at prices that wouldn't be determined until harvest time, using financial instruments that created mutual benefits for both producers and merchants. The system worked brilliantly until weather disasters in 1267 destroyed wool production across southern England and revealed the risks that Ricardo's innovative contracts had hidden. Shepherds who had promised to deliver specific quantities of wool at fixed prices suddenly couldn't fulfill their obligations because their flocks had died from disease and starvation. Traditional commodity trading would have resulted in simple business losses. Shepherds would default on their contracts, merchants would lose their advance payments, and everyone would absorb their losses individually. But Ricardo's integrated financing system meant that production failures affected every participant in interconnected ways that nobody had anticipated. When shepherds couldn't deliver wool, Ricardo couldn't fulfill contracts with Flemish weavers, who had already received advance payments from Italian textile merchants who had promised finished cloth to customers across the Mediterranean. A local weather disaster was cascading through international supply chains in ways that seemed impossible, but were actually inevitable once everyone's obligations became interconnected. Think about what this revealed. Ricardo had accidentally discovered how financial integration could amplify local problems into systemic crises. The same innovations that made international commerce more efficient also made it more fragile, because disruptions anywhere in the network would affect participants everywhere else. His response to this crisis established principles that would guide bardi banking strategy for the next century, and ultimately lead to their destruction. Instead of accepting losses and retreating to simpler business models, Ricardo doubled down on financial innovation. He developed insurance contracts to hedge against weather risks, created partnership agreements to spread losses across multiple investors, and established reserve funds to maintain liquidity during temporary disruptions. These risk management tools worked exactly as intended, transforming potentially catastrophic losses into manageable business expenses. But they also created moral hazard by making risky activities seem safer than they actually were. When innovative financial instruments could minimize the consequences of bad decisions, people started making increasingly bad decisions. By 1275, The Bardi wool trading network included over 200 English producers, 50 Flemish weavers, and 30 Italian textile merchants, all connected through credit arrangements that generated profits for everyone while concentrating risks in ways that nobody fully understood. Ricardo had built Europe's first multinational corporation by accident, simply by trying to solve logistical problems in international wool trading. The success attracted competitors who copied the Bardi innovations while trying to steal their most profitable relationships. The Peruzzi family began offering better terms to English wool producers. The Acciaiuoli started providing more flexible credit to Flemish weavers. Competition drove all the Italian banking families to develop increasingly sophisticated financial services that made medieval commerce possible and increasingly dangerous. What nobody realized was that they were building the foundation for Europe's first systemic financial crisis. Every innovation that made commerce more efficient also made it more interconnected. Every solution that reduced one type of risk created new types of risk that nobody knew how to measure or manage. By 1280, Riccardo de' Bardi controlled the most advanced financial network in medieval Europe, had pioneered banking innovations that wouldn't be widely adopted for centuries, and was generating profits that were transforming his family from middle-class wool merchants into aristocratic financiers. But he had also created something that was beyond any individual's ability to control. A credit system so complex and interconnected that its collapse would threaten the entire foundation of European commerce. Chapter 2. Royal Gamble. The decision that would eventually destroy the Bardi banking empire was made in a smoky tavern in Westminster on a cold February night in 1294. Edward I of England, desperate for money to finance his wars in Wales and Scotland, was drinking ale with Italian bankers while plotting the most audacious financial scheme in medieval history, borrowing against future tax revenues that might never materialize. Riccardo de' Bardi, now 60 years old and the most successful international banker in Europe, listened to the English king's proposal with the careful attention of someone who understood that royal loans could either create unprecedented wealth or destroy everything his family had built over 3 decades. You see, lending money to kings was fundamentally different from financing wool merchants or textile manufacturers. Merchants had tangible assets that could be seized if they defaulted on their loans. Their businesses generated measurable cash flows that provided reasonable estimates of repayment capacity. Kings, by contrast, owned everything and nothing. They controlled vast territories and populations, but their actual ability to convert that control into cash payments depended on political factors that no financial analysis could predict. Edward's proposal was breathtakingly simple and terrifyingly dangerous. The Bardi Bank would advance enormous sums to fund immediate military campaigns, and England would repay these loans using tax revenues collected from conquered territories and defeated enemies. If the military campaigns succeeded, the loans would be repaid with interest rates of 50–60% annually. If the campaigns failed, the Bardi would lose everything they had lent. Here's what's fascinating. This wasn't just gambling. It was the invention of sovereign debt financing, centuries before modern governments developed systematic approaches to borrowing against future economic growth. Edward was essentially selling shares in the profitability of English imperialism to Italian investors who had no way to evaluate the risks they were assuming. But the potential profits were so enormous that they overwhelmed rational risk assessment. Successful royal loans could generate returns that were impossible through normal commercial activities. A single profitable war could produce enough interest payments to fund decades of expansion for ambitious banking families. The Bardi had spent 30 years building their wool trading network. One successful royal loan could multiply their wealth tenfold within 5 years. Riccardo's decision to accept Edward's proposal reflected sophisticated analysis of risks and opportunities that revealed just how advanced Bardi financial thinking had become. They wouldn't simply lend money and hope for repayment. They would structure the loans to minimize their exposure while maximizing their control over the factors that determined success or failure. Look, this was revolutionary financial engineering. The Bardi developed what we now recognize as performance-based lending, where loan terms adjusted based on the borrower's ability to meet specific benchmarks. If Edward's military campaigns captured Welsh silver mines as promised, interest rates would decrease and repayment schedules would extend. If campaigns failed to generate expected revenues, the bardi would receive land grants and trading privileges that provided alternative sources of repayment. The contracts they negotiated were masterpieces of medieval legal innovation, creating binding obligations that survived changes in political leadership, military defeats, and economic disruptions that would normally void commercial agreements. They essentially invented sovereign debt instruments that modern international lawyers still study as examples of how to structure complex cross-border financial relationships. But the most important innovation was psychological rather than legal. By linking their financial success to Edward's military success, the bardi became invested partners in English imperialism rather than passive creditors hoping for repayment. They provided strategic advice, logistical support, and diplomatic connections that made them indispensable to royal decision-making. This partnership approach generated enormous profits while creating dependencies that seemed to protect the bardi from the risks of royal default. Edward couldn't afford to destroy his relationship with the bankers who made his military campaigns possible. The bardi couldn't afford to let Edward fail because his failure would wipe out their investments. The first test of this system came during Edward's conquest of Wales, which required financing that exceeded the annual tax revenues of most European kingdoms. Traditional military campaigns were funded through immediate taxation or plunder from conquered territories. Edward's strategy required advance financing for equipment, supplies, and mercenary soldiers that wouldn't be paid back until after victories that might never occur. Think about the scale of this financial risk. The bardi were essentially betting their family's entire accumulated wealth on the military competence of a foreign king whose track record included several expensive failures. If Edward's Welsh campaigns collapsed, the bardi would lose not just their investment, but their credibility with other clients who depended on their financial stability. Yet the psychological logic was compelling. Edward was one of medieval Europe's most successful military leaders, with proven ability to convert military victories into long-term economic advantages. Wales contained silver mines and agricultural resources that could generate revenues far exceeding the cost of conquest. The political benefits of successful expansion would strengthen England's position in European affairs, creating additional opportunities for profitable collaboration. When the Welsh campaigns succeeded beyond expectations, generating conquest revenues that exceeded even optimistic projections, the bardi's royal lending strategy seemed vindicated. They had pioneered a form of investment banking that created wealth through successful military entrepreneurship, while building strategic relationships that opened new markets throughout the English sphere of influence. The success attracted attention from competing Italian banking families, who began offering similar services to other European monarchs. The Peruzzi started financing French military campaigns. The Acciaiuoli developed relationships with Hungarian kings. Competition drove all the major banking houses to accept increasingly dangerous royal lending commitments in pursuit of the extraordinary profits that successful military financing could generate. But this competitive escalation created systemic risks that nobody fully appreciated. When multiple banks were financing competing monarchs, military conflicts between royal borrowers created conflicts of interest that threatened the entire international banking system. The bardi's investments in English military success became incompatible with their competitors' investments in French military success when England and France went to war. By 1300, European royal finances had become so dependent on Italian banking credit that military campaigns were essentially proxy wars between competing financial institutions. The banks weren't just lending money to kings. They were indirectly financing conflicts that would determine the political and economic structure of medieval Europe. Riccardo de' Bardi died in 1310, believing he had solved the fundamental problem of medieval banking: how to generate returns large enough to justify the enormous risks of international finance. His sons inherited not just vast wealth, but financial relationships that seemed to guarantee continued prosperity through partnerships with the most powerful political leaders in Europe. What they actually inherited was a banking strategy so dangerous that its inevitable failure would destroy not just their family's fortune, but the entire foundation of medieval financial systems. The trap was already closing, though none of them understood it yet. Chapter 3. Credit Empire. By 1320, the Bardi Bank controlled a financial empire that spanned from London to Constantinople and generated more international transactions than most kingdoms' entire treasuries. Giovanni de Bardi, Riccardo's eldest son, commanded credit networks that could move enormous sums across Europe without physically transporting a single coin, manipulate currency exchange rates across dozens of different monetary systems, and provide financing for everything from papal crusades to Flemish textile production. But Giovanni had inherited more than just wealth. He had inherited a business model that required continuous expansion to remain profitable. The Bardi banking system was essentially a massive credit pyramid that depended on constantly finding new borrowers who could pay higher interest rates than the bank paid to its depositors. When expansion stopped, the entire structure would collapse under the weight of its own financial obligations. You see, medieval banking faced fundamental challenges that didn't exist in simpler cash-based economies. Banks needed to maintain liquidity reserves to meet depositor demands, but profitable investments typically required long-term commitments that tied up capital for months or years. They needed to diversify their risks across multiple borrowers and markets, but diversification required expertise and connections that took decades to develop. Most importantly, they needed to generate returns high enough to justify the enormous risks of lending money to people they couldn't directly control or supervise. Giovanni's solution was to create what modern economists would recognize as financial intermediation on a continental scale. The Bardi Bank became the central hub for European commerce, taking deposits from wealthy merchants and aristocrats, then lending that money to borrowers across dozens of different markets and industries. They earned profits from the spread between deposit interest rates and lending rates while providing liquidity services that made complex international transactions possible. Here's what's fascinating. Giovanni was essentially creating Europe's first central banking system, centuries before governments understood the economic functions that central banks needed to perform. The Bardi Bank maintained currency reserves in multiple countries, provided emergency lending to merchants facing temporary cash flow problems, and facilitated international payments that would have been impossible using primitive governmental financial systems. But the most revolutionary innovation was organizational rather than financial. Giovanni realized that controlling information was more valuable than controlling money, because superior information allowed the bank to make better lending decisions, identify profitable opportunities before competitors, and avoid risks that would destroy less sophisticated institutions. The Bardi developed Europe's most advanced commercial intelligence network, with correspondents in every major trading city who reported market conditions, political developments, and business opportunities that could affect the bank's far-flung investments. They knew about crop failures in England before English merchants learned about them. They received advance warning of political upheavals in France before French bankers understood what was happening. Look, this information advantage was so significant that it essentially created different categories of market participants. The Bardi could make decisions based on accurate current data, while their competitors operated using rumors, speculation, and outdated information that led to costly mistakes. Superior intelligence translated directly into superior profits, which provided the capital needed to expand their intelligence networks even further. The practical implementation required innovations in communication, accounting, and legal frameworks that were centuries ahead of their time. Giovanni established standardized reporting procedures that allowed managers in London, Paris, and Naples to coordinate their activities using consistent financial data. He developed accounting methods that could track complex multi-party transactions across different currencies and legal jurisdictions. Most importantly, he created contractual frameworks that protected the bank's interests, even when local political conditions changed dramatically. By 1325, the Bardi Bank employed over 300 people across Europe, maintained permanent offices in 17 cities, and handled financial transactions worth millions of florins annually. They had become indispensable to international commerce because no other institution could match their combination of capital resources, geographic reach, and operational sophistication. But success created new vulnerabilities that Giovanni didn't fully understand. The bank's widespread operations made it dependent on political stability in dozens of different jurisdictions, any of which could disrupt profitable activities through changes in law, taxation, or military conflict. Their complex credit relationships meant that problems in one market could cascade through their entire network in ways that were difficult to predict or control. Most dangerously, their reputation for reliability had made them the preferred lender for increasingly risky borrowers who couldn't obtain credit elsewhere. Kings, nobles, and merchants who approached the bardi for loans were typically seeking financing for activities that other banks had already rejected as too dangerous. The bardi's superior risk assessment capabilities allowed them to profit from lending to marginal borrowers, but it also concentrated high-risk investments in ways that could overwhelm even sophisticated risk management systems. Think about what this meant for the stability of European finance. The most advanced banking institution was systematically taking on the riskiest lending opportunities while becoming more essential to international commerce. When the bardi succeeded, they generated enormous profits that funded further expansion. When they failed, their failure would disrupt economic relationships across the entire continent. The warning signs were already visible to anyone who understood the mathematics of exponential growth applied to financial leverage. The bardi's loan portfolio was growing faster than their capital base, meaning they were becoming increasingly dependent on borrowed money to fund new lending. Their geographic diversification was creating operational complexity that made risk assessment more difficult rather than easier. Most importantly, their success was attracting imitators who copied their methods while competing for their most profitable clients. Competition from other Italian banking families forced the bardi to accept increasingly marginal lending opportunities to maintain their growth rates. The Peruzzi were offering better terms to English merchants. The Acciaiuoli were undercutting bardi interest rates in Eastern European markets. Every major banking house was bidding against every other banking house for access to the limited number of credit-worthy borrowers who could generate high returns. This competitive pressure created what modern economists call a race to the bottom in lending standards. Banks that maintained conservative risk assessment procedures lost profitable clients to competitors who were willing to accept higher risks in exchange for higher returns. The most successful banks were those that could convince themselves and their depositors that they had found ways to generate superior returns without accepting proportionally higher risks. Giovanni understood these dynamics, but he believed the bardi's superior capabilities would allow them to navigate dangers that would destroy their less sophisticated competitors. Their information networks would help them avoid bad investments. Their diversified operations would protect them from localized problems. Their strong relationships with powerful clients would provide protection during economic downturns. What he didn't understand was that he was building a financial institution too big to fail in an era when no governmental or institutional mechanisms existed to prevent catastrophic failures. When the Bardi Bank eventually collapsed, there would be no central bank to provide emergency liquidity, no government deposit insurance to protect individual savers, and no international cooperation frameworks to manage cross-border financial crises. By 1330, Giovanni de' Bardi controlled the most advanced financial institution in medieval Europe, but he had also created something beyond any individual's ability to control or comprehend. The credit empire he had inherited and expanded was about to encounter stresses that would reveal just how dangerous financial innovation could become when it outpaced the political and legal systems designed to contain its risks. Chapter 4. War Loans. The meeting that sealed the Bardi Bank's fate took place in the Tower of London on March 15, 1337, when Edward III of England summoned Giovanni de' Bardi's son, Alessandro, to discuss the most audacious military financing scheme in medieval history. England was about to launch the 100 Years' War against France, and Edward needed more money than existed in the entire English treasury. money that only Italian bankers could provide. Alessandro de Bardi, now 35 and managing the family's English operations, understood that this meeting represented either the greatest opportunity or the deadliest trap in Bardi banking history. Edward was proposing loans worth over 600,000 florins, roughly equivalent to $2 billion in modern currency, to finance military campaigns that could either establish English dominance over continental Europe or bankrupt England completely. You see, the 100 Years' War wasn't just a conflict between England and France. It was a struggle for control over the most profitable commercial territories in medieval Europe. The winner would dominate international trade routes, control access to Flemish textile markets, and collect tribute from the wealthiest merchant cities on the continent. The loser would face economic isolation, military humiliation, and the collapse of political systems that had taken centuries to build. For Italian bankers, this represented the ultimate risk-reward calculation. Financing the winning side would generate profits and political influence beyond anything achievable through normal commercial activities. Financing the losing side would mean catastrophic losses that could destroy even the strongest banking houses. The problem was that nobody could predict which side would win a war that was expected to last decades and involve military strategies that had never been tested on such a massive scale. Edward's proposal was brilliant in its complexity and terrifying in its implications. Instead of simply borrowing money and promising repayment, he offered the Bardi Bank partnership in English imperialism itself. They would finance his military campaigns in exchange for shares of conquest revenues, exclusive trading rights in captured territories, and political influence that would make them partners in governing a potentially expanded English empire. Here's what's fascinating. This wasn't just military financing. It was the invention of what modern economists call sovereign wealth partnerships, where private financial institutions become stakeholders in national economic policy rather than just creditors hoping for repayment. Alessandro would essentially be investing in Edward's ability to reshape the political map of medieval Europe. But the financial structure required innovations that pushed medieval banking far beyond its normal operational limits. The loans couldn't be secured by traditional collateral because England's ability to repay depended entirely on military victories that might never occur. Interest payments couldn't follow normal schedules because military campaigns generated revenues unpredictably and often years after expenses were incurred. Most challenging, the entire arrangement had to remain secret because revealing England's financial dependence on Italian credit would undermine the psychological warfare that was crucial to medieval military success. Alessandro's response revealed just how sophisticated Bardi financial analysis had become. They wouldn't simply lend Edward money and hope for the best. They would structure a complex arrangement that protected their interests while maximizing their potential returns from successful English imperialism. The contracts they negotiated created what was essentially the first international venture capital fund, with the Bardi as primary investors and Edward as managing partner. If English military campaigns succeeded, profits would be shared according to predetermined formulas that gave the Bardi substantial returns on their investments. If campaigns failed, the Bardi would receive alternative compensation through land grants, trading privileges, and tax exemptions that provided some protection against total losses. Look, this was revolutionary thinking that anticipated modern concepts of risk-adjusted returns by centuries. Alessandro understood that lending money at fixed interest rates made no sense when the borrower's ability to repay depended on highly uncertain future events. Instead, he created variable return structures that aligned the bank's interests with Edward's military success while providing multiple pathways to profitability. The psychological dimensions were equally sophisticated. By making themselves Edward's financial partners rather than just his creditors, the Bardi gained influence over English strategic decision-making that protected their investments while creating opportunities for additional profits. They could advise Edward on military strategies that would maximize economic returns from conquest. They could help negotiate post-war settlements that favored commercial interests. They could use their international connections to gather intelligence that improved English chances of military success. But this partnership approach also created dependencies that would prove catastrophic if English military campaigns failed to meet expectations. The Bardi weren't just risking their money, they were risking their reputation, their relationships with other clients, and their ability to attract future deposits from investors who expected conservative risk management from Europe's most successful banking institution. The first phase of the arrangement worked exactly as designed. English military campaigns in France achieved stunning early successes that generated conquest revenues far exceeding initial projections. The Battle of Crécy in 1346 alone produced enough plunder to cover the Bardi's initial investments, while demonstrating Edward's military competence to potential critics of the financing arrangement. These early successes created what modern behavioral economists recognize as overconfidence bias, the tendency to extrapolate from limited positive results to predictions of continued success that aren't supported by statistical analysis. Alessandro began viewing English military superiority as a permanent advantage rather than a temporary tactical situation that could change based on French strategic adaptations. I mean, think about what this reveals about the psychology of high-stakes financial decision-making. When sophisticated analytical tools produce profitable results, it becomes psychologically difficult to recognize when those same tools are generating signals that contradict earlier successful decisions. The Bardi's advanced risk assessment capabilities became liabilities when they were used to rationalize increasingly dangerous investments in English military ventures. The competitive pressures that had driven the Bardi to accept Edward's initial loan proposal became even more intense as other Italian banking families recognized the enormous profits that military financing could generate. The Peruzzi Bank began providing credit to French military campaigns. The Acciaiuoli started financing Hungarian and Polish military ventures. Competition forced all the major banking houses to accept increasingly risky royal lending commitments in pursuit of the extraordinary returns that successful military partnerships could provide. This created what modern economists recognize as systemic risk concentration, when multiple financial institutions pursue similar high-risk strategies that appear to be independent but are actually correlated in ways that amplify rather than diversify overall risk exposure. The Italian banks thought they were hedging their bets by financing different monarchs, but they were actually creating conditions where military conflicts between their royal clients would become conflicts between competing financial institutions. By 1340, the Bardi Bank had lent Edward III over 1 million florins, more money than most countries' entire annual economic output. They had become so essential to English military operations that Edward's strategic decisions were influenced by their financial constraints and investment priorities. The 100 Years' War was essentially being managed by a partnership between English political leadership and Italian financial expertise. But this integration created vulnerabilities that neither party fully understood. The Bardi's success had made them indispensable to Edward, but it had also made Edward indispensable to them. If English military campaigns failed, the Bardi would face losses that could destroy their entire banking network. If the Bardi withdrew their financial support, Edward would lose his ability to continue military operations that were consuming enormous resources without generating corresponding revenues. What nobody realized was that they had created a mutually assured destruction scenario where both parties' survival depended on military successes that were becoming increasingly difficult to achieve as the war dragged on and French resistance strategies evolved. The financial partnership that had seemed to reduce risks by aligning interests was actually amplifying risks by creating interdependencies that made rational exit strategies impossible. The trap was closing, and there was no way out that didn't involve catastrophic losses for everyone involved. Chapter 5. Debt Mountain. By 1341, Edward III of England owed Italian bankers more money than had ever been owed by any monarch in European history. The Bardi Bank alone held English debt worth 900,000 florins, roughly equivalent to 15 years of England's total tax revenues. When combined with obligations to the Peruzzi, Acciaiuoli, and smaller Florentine institutions, Edward's total debt exceeded 1.5 million florins, creating a financial obligation that was mathematically impossible to repay through normal governmental revenues. Alessandro de Bardi stared at the latest accounting reports from London with the growing realization that his family's banking empire had become a prisoner of its own success. The profits from English military financing had been so enormous that the Bardi had continued lending even after rational risk analysis should have warned them to stop. They were trapped in what modern economists call a sunk cost fallacy, continuing to invest in increasingly hopeless situations because the alternative meant accepting catastrophic losses on previous investments. You see, the mathematics of royal debt in medieval Europe followed different rules than commercial lending. Merchants who couldn't repay their loans faced imprisonment, seizure of assets, and legal consequences that forced them to prioritize debt service above all other obligations. Kings who couldn't repay their loans faced absolutely nothing. There were no international courts that could compel sovereign debt payments. There were no enforcement mechanisms that could force monarchs to honor financial obligations to foreign creditors. This fundamental asymmetry meant that royal lending was essentially a confidence game based on mutual self-interest rather than legal enforceability. Kings repaid their debts only when they needed continued access to credit or when default would damage their political relationships in ways that outweighed the benefits of avoiding payment. Italian bankers lent to kings only when they believed the political and economic benefits of repayment exceeded the psychological and financial benefits of default. But the 100 Years' War was systematically destroying the incentive structures that made royal lending profitable. Military campaigns that had initially generated conquest revenues were now consuming resources faster than they could be replaced. English control over French territories was proving temporary and expensive to maintain. Most dangerously, the war's duration was exceeding everyone's planning horizons, creating financial obligations that stretched beyond any reasonable timeline for repayment. Here's what's fascinating. Alessandro understood these problems better than most medieval financiers, but his superior analytical capabilities actually made his situation worse rather than better. He could calculate with mathematical precision exactly how hopeless England's debt situation had become, but he could also calculate how much the Bardi would lose if they acknowledged that hopelessness and wrote off their English investments. The accounting was brutal in its clarity. If Edward repaid his debts as promised, the Bardi would realize profits that would make them the wealthiest banking family in Europe. If Edward defaulted, the Bardi would face losses that would destroy their capital base and potentially bankrupt their entire operation. There was no middle ground. The scale of their English exposure meant that partial repayment wouldn't provide enough returns to justify the risks they had accepted. Look, this was a textbook example of what modern financial theorists call the gambler's fallacy, applied to international banking. Alessandro kept increasing his bets because admitting that previous bets were losing would mean accepting losses that seemed unbearable. Each additional loan to Edward was justified as protecting previous investments rather than as an independent decision that could be evaluated on its own merits. The psychological pressures were enormous and contradictory. The Bardi's reputation for financial sophistication meant that admitting they had made catastrophic lending decisions would damage their credibility with other clients who depended on their risk assessment capabilities. But continuing to lend money to an increasingly insolvent borrower violated every principle of conservative banking that had built their reputation for reliability. Alessandro's solution was to restructure the English debt in ways that concealed its true magnitude while providing face-saving justifications for continued lending. Instead of acknowledging that Edward couldn't repay existing loans, Alessandro negotiated new agreements that converted outstanding debts into long-term obligations secured by future conquest revenues that might never materialize. These debt restructuring arrangements were masterpieces of medieval financial engineering that disguised insolvency through accounting innovations that wouldn't be fully understood until modern economics developed sophisticated theories about how financial institutions respond to systemic risks. Alessandro was essentially creating what we now recognize as zombie lending, continuing to provide credit to insolvent borrowers in order to avoid acknowledging that previous loans had become worthless. But the restructuring created new problems that were worse than the original lending risks. The modified loan agreements gave Edward additional time to repay his debts, but they also gave him additional opportunities to accumulate even more debt, while his fundamental insolvency remained unchanged. The bardi were lending good money after bad, while hoping that time would somehow solve problems that were actually getting worse with each passing month. I mean, consider what this reveals about the psychology of institutional decision-making under extreme pressure. Alessandro was one of the most sophisticated financial analysts in medieval Europe, with access to better information and more advanced risk assessment tools than any of his competitors. Yet he was making decisions that violated his own expertise because the alternative, accepting enormous losses, seemed psychologically impossible. The competitive dynamics made rational decision-making even more difficult. The Peruzzi and Acciaiuoli banks were facing similar problems with their own royal lending portfolios, but none of the Italian banks could afford to be the first to acknowledge that sovereign debt markets had become dangerously unsustainable. Whoever withdrew from royal lending first would lose access to the enormous profits that successful monarchs could provide, while potentially triggering panic among depositors who would question the institution's financial judgment. This created what modern game theorists recognize as a coordination problem, where individually rational strategies produce collectively irrational outcomes. Each bank continued lending to increasingly insolvent monarchs because stopping would mean acknowledging that their competitors' similar strategies were also doomed to fail. They were trapped in a race toward bankruptcy that none of them could afford to lose and none of them could afford to win. By 1342, the Bardi Bank's English exposure represented over 60% of their total assets, a concentration ratio that violated every principle of prudent risk management that medieval banking had developed through centuries of painful experience. They had essentially bet their entire institutional survival on Edward III's ability to generate revenues from military campaigns that were consuming resources faster than any conquest could replace them. The warning signs were everywhere for anyone willing to see them. English tax revenues were declining as the war disrupted normal economic activity. French resistance was becoming more organized and effective, making conquest revenues increasingly difficult to obtain. Most ominously, Edward was beginning to show signs of considering default as a politically acceptable alternative to continued debt service. Alessandro de' Bardi understood all of these danger signals, but he also understood that acknowledging them meant destroying everything his family had built over 3 generations of careful wealth accumulation. The debt mountain they had created was too large to climb and too dangerous to abandon. The only question was whether it would bury them slowly or quickly. Chapter 6: Fatal Promise. The document that would destroy medieval Europe's greatest banking empire was just 2 pages of elegant Latin script, sealed with royal wax and signed with a flourish that betrayed none of the desperation behind its creation. On September 12, 1343, Edward III of England signed what he called a covenant of perpetual friendship with the Bardi Bank, a financial agreement so audacious that it essentially pledged the entire future economic output of England to Italian creditors in exchange for one final massive loan. Alessandro de' Bardi held the sealed document with trembling hands, knowing that he was looking at either his family's salvation or their death warrant. The agreement promised that England would repay all outstanding debts, plus interest within 18 months, using revenues from a new military campaign that would capture French silver mines and establish English control over Flemish wool markets. If the campaign succeeded, the Bardi would receive returns that would make them the wealthiest family in Europe. If it failed, both Edward and the Bardi would face financial destruction on a scale that medieval Europe had never witnessed. You see, by 1343, both parties were trapped in a financial nightmare that offered no rational solutions. Edward owed the Italian banks more money than England could generate through taxation, conquest, or economic development within any reasonable timeline. The Bardi had lent so much money to Edward that they couldn't absorb the losses from default without destroying their entire banking network and ruining thousands of depositors who trusted them with their life savings. This created what modern economists call a mutual hostage situation, where both parties' survival depends on continued cooperation, even when that cooperation requires increasingly irrational decisions. Edward couldn't admit insolvency without triggering a default that would destroy his credibility with other potential lenders. Alessandro couldn't acknowledge Edward's insolvency without admitting that the Bardi's lending decisions had been catastrophically incompetent. The covenant of perpetual friendship was designed to solve this impasse through what was essentially medieval Europe's first debt-for-equity swap. Instead of simply lending more money to an insolvent borrower, the Bardi would become partners in a comprehensive economic development program that would transform England's debt obligations into shared investments in future prosperity. Here's what's fascinating. The agreement contained financial innovations that wouldn't be widely understood until modern corporate finance developed sophisticated theories about how to structure partnerships between creditors and debtors when traditional lending relationships had broken down. Alessandro was essentially converting the Bardi from passive lenders into active managers of English economic policy. The practical terms were unprecedented in their scope and complexity. The Bardi would provide immediate financing for Edward's military campaigns while receiving management rights over English customs revenues, mining operations, and international trade policies. They would establish permanent offices in London with authority to collect taxes, negotiate commercial agreements, and supervise economic development projects that would generate revenues to service England's debt obligations. Look, this wasn't just financial restructuring. It was the partial privatization of English governmental functions, with Italian bankers assuming responsibilities that had traditionally been reserved for royal administrators. Alessandro would essentially become England's finance minister, with power to make economic decisions that affected millions of English subjects who had never consented to foreign financial control. But the most revolutionary aspect was temporal rather than administrative. The agreement acknowledged that England's existing debt obligations couldn't be repaid within normal human planning horizons, so it created what was essentially a perpetual bond structure, where debt service would continue across multiple generations of both English monarchs and Bardi banking leaders. This intergenerational approach to debt management reflected Alessandro's recognition that royal lending had outgrown the institutional frameworks that medieval Europe had developed to handle complex financial relationships. Traditional commercial loans were structured to be repaid within the lifetime of the original parties to the agreement. Royal loans had become so large and complex that they required legal and financial innovations that could survive changes in political leadership, military fortunes, and economic conditions that nobody could predict or control. I mean, think about what this meant for the fundamental nature of medieval political and economic relationships. Alessandro was creating contractual obligations that would bind future English kings to honor financial commitments made by their predecessors, regardless of whether those commitments reflected sound economic judgment or political necessity. The enforcement mechanisms were equally innovative and equally problematic, since international law provided no effective tools for compelling sovereign debt payments. The agreement created what were essentially economic hostages, English commercial activities that would be controlled by Italian financial interests until debt obligations were fully satisfied. The Bardi would assume management control over England's most profitable economic sectors, including wool exports, mining operations, and customs collections. This gave them direct access to the revenue streams that would fund debt repayment, but it also made them responsible for maintaining the economic activities that generated those revenues. They weren't just creditors hoping for payment. They were economic partners whose success depended on England's continued prosperity. But this partnership structure created new vulnerabilities that neither party fully understood. The Bardi's direct involvement in English economic management made them responsible for policy decisions that affected England's military capabilities, political stability, and international relationships. If their financial policies weakened England's ability to defend itself or maintain internal order, they would be destroying the economic foundation that supported their own investments. The military dimensions were even more complex. The agreement committed England to specific military campaigns that were designed primarily to generate revenues for debt service rather than to advance English strategic interests. Edward would essentially be fighting wars chosen by his Italian creditors, based on their financial analysis rather than his military judgment. This created what modern strategic theorists recognize as principal-agent conflicts in military decision-making, where the people making strategic decisions have different objectives than the people who bear the costs and risks of implementation. Alessandro's financial priorities might require military campaigns that were profitable but strategically counterproductive, while Edward's political priorities might require military campaigns that were strategically necessary but financially ruinous. The domestic political implications were potentially catastrophic for both parties. English nobles and merchants, who discovered that their economic policies were being determined by foreign bankers, would likely respond with the kind of xenophobic nationalism that had destroyed Italian commercial operations in other countries. Italian depositors who learned that their savings were being used to finance the political subjugation of foreign kingdoms would likely withdraw their funds and seek more conservative investment alternatives. Alessandro understood these risks, but he believed the Bardi's superior financial expertise would allow them to manage English economic policy more effectively than English administrators who lacked sophisticated understanding of international commerce and monetary policy. They would demonstrate that professional financial management could generate prosperity that would benefit everyone involved while providing resources to service debt obligations that seemed impossible under existing economic arrangements. What he didn't understand was that financial expertise, however sophisticated, couldn't solve political and military problems that were fundamentally non-financial in nature. The success of his innovative debt restructuring depended on military victories that were becoming increasingly unlikely, political stability that was being undermined by the financial arrangements themselves, and economic growth that was mathematically impossible given the debt service obligations he was trying to manage. The Covenant of Perpetual Friendship was signed with great ceremony in the Tower of London, witnessed by English nobles who didn't understand its financial implications and blessed by Italian priests who didn't understand its political consequences. Both Edward and Alessandro believed they had created an arrangement that would solve their mutual financial crisis while establishing a new model for international economic cooperation. Within 18 months, the document would be worthless parchment. The Bardi Bank would be bankrupt, and medieval Europe would be experiencing its first truly systemic financial crisis. But on September 12, 1343, Alessandro de' Bardi walked out of the Tower of London, believing he had just saved his family's financial empire through the most sophisticated debt restructuring arrangement in medieval history. He was about to discover that some financial problems are too large to be solved by financial innovation alone. Chapter 7. Default Cascade. The end began with a single sentence in a letter that arrived at the Bardi Bank's Florence headquarters on the morning of August 31st, 1345. Edward III's personal secretary, writing in the formal Latin that medieval chancelleries used for official communications, informed Alessandro de' Bardi that His Majesty finds himself unable to honor the financial obligations previously agreed upon with your esteemed institution, and requests your patience while alternative arrangements are considered. 24 words. 2 years of the most sophisticated financial engineering in medieval Europe, destroyed by 24 words that didn't even have the courtesy to use the word default. Alessandro read the letter 3 times before its implications penetrated the psychological denial that had sustained him through months of increasingly desperate attempts to avoid exactly this moment. Edward III, King of England, partner in the Covenant of Perpetual Friendship, debtor of nearly 1 million florins, had just declared bankruptcy in the most polite language possible while simultaneously destroying the financial foundation that supported thousands of families across Europe. You see, Edward's default wasn't just a business failure. It was the collapse of medieval Europe's first experiment with systematic international credit. For over a century, Italian banks had been developing increasingly sophisticated methods for managing the risks of cross-border lending, creating financial innovations that made complex commercial relationships possible across different legal and monetary systems. Edward's repudiation of his obligations didn't just bankrupt individual institutions, It revealed that the entire theoretical foundation of international banking was built on assumptions that proved false under extreme stress. Here's what's fascinating. Alessandro had been preparing for this moment for over 2 years, developing contingency plans that were designed to minimize losses from potential English default. The Bardi had diversified their lending across multiple countries, maintained currency hedges to protect against exchange rate fluctuations, and negotiated collateral agreements that were supposed to provide alternative sources of repayment if primary debtors failed to honor their obligations. But Edward's default revealed that sophisticated risk management techniques were useless when the fundamental assumptions underlying the entire system proved incorrect. The Bardi's diversification strategies had actually concentrated rather than reduced their risks, because all of their major borrowers were European monarchs facing similar military and financial pressures. Their currency hedges provided no protection against political repudiation of debt obligations. Their collateral agreements were worthless because there were no enforcement mechanisms that could compel sovereign borrowers to honor contracts they no longer wanted to respect. Look, this was medieval Europe's first encounter with what modern economists call systemic risk. When the failure of one major institution triggers cascading failures throughout an interconnected financial system in ways that can't be prevented through diversification or individual risk management strategies. The immediate impact was mathematically predictable and psychologically devastating. The Bardi Bank's English loans represented approximately 65% of their total assets, meaning that Edward's default immediately wiped out most of their capital base while leaving them with continuing obligations to depositors who had entrusted them with their life savings. They faced a liquidity crisis that couldn't be solved through normal business operations because their primary source of revenue had just vanished overnight. But the psychological impact was even worse than the financial damage. Alessandro de Bardi had built his reputation on his ability to assess and manage lending risks that were beyond the capabilities of less sophisticated institutions. Edward's default proved that even the most advanced risk assessment techniques were inadequate when dealing with borrowers who could simply choose not to repay their debts whenever repayment became inconvenient. The news spread through Florence's financial district with the speed of wildfire, carried by banking clerks, merchant representatives, and aristocratic investors who understood that the Bardi collapse threatened the stability of the entire Florentine banking system. By afternoon, crowds had gathered outside the Bardi palaces, demanding explanations, withdrawal of deposits, and accountability from the banking family that had seemed invincible just 24 hours earlier. Think about what this reveals about the psychology of financial confidence during crisis situations. The same depositors who had competed to place their money with the prestigious Bardi Bank suddenly viewed their deposits as existential threats that had to be recovered immediately, regardless of the practical impossibility of simultaneous mass withdrawals from any financial institution. The Bardi's attempt to maintain normal operations while managing the crisis created additional problems that accelerated their collapse. Alessandro announced that the bank would honor all withdrawal requests, but asked depositors to be patient while liquid assets were converted into cash through orderly asset sales. This reasonable approach to crisis management was interpreted as evidence that the Bardi were insolvent and trying to delay inevitable bankruptcy through accounting manipulation. The resulting bank run followed the mathematical dynamics that would be familiar to modern students of financial crises. Depositors who withdrew their funds early received full repayment, while those who waited faced increasing probability of total loss as the bank's liquid assets were exhausted. This created incentives for panic withdrawals that became self-fulfilling prophecies. The fear of bank failure caused the behaviors that made bank failure inevitable. But the Bardi crisis was more than just a localized bank run. Alessandro's sophisticated financial innovations had connected the Bardi to dozens of other banking institutions through complex credit arrangements that created mutual dependencies across the entire Florentine financial system. When the Bardi failed, they triggered defaults on obligations to partner banks that had seemed completely separate from English royal lending. The Peruzzi Bank, which had seemed safely diversified through their focus on French and Eastern European lending, discovered that they had provided substantial short-term credit to the Bardi that was secured by English debt obligations that were now worthless. The Acciaioli Bank faced margin calls on currency hedging arrangements that they couldn't meet because their counterparty, the bardi, was no longer able to honor their financial commitments. Here's what's interesting. Medieval banking had accidentally created the same kinds of interconnected risk exposures that would characterize modern financial crises, but without any of the institutional mechanisms that modern economies use to manage systemic failures. There were no central banks to provide emergency liquidity, no government deposit insurance to protect individual savers, and no regulatory frameworks for managing the orderly liquidation of failed financial institutions. The cascade continued with inexorable mathematical logic. Each bank failure reduced confidence in the remaining institutions, creating deposit withdrawals that forced additional failures even among banks that had maintained conservative lending practices and should have been able to survive temporary liquidity pressures. The fear of systemic collapse became the cause of systemic collapse, as rational individual decisions produced collectively irrational outcomes. Within 6 weeks of Edward's default announcement, 14 major banking institutions in Florence had either failed completely or suspended normal operations while attempting to restructure their obligations to depositors and creditors. The city that had been medieval Europe's financial capital had essentially lost its entire banking sector overnight, creating economic disruption that affected commercial relationships across the continent. The human cost was staggering and immediate. Thousands of middle-class merchants and artisans who had accumulated savings through decades of careful work discovered that their wealth had vanished because they had trusted prestigious banking institutions with risk management capabilities that proved to be illusory. Aristocratic families who had financed their lifestyles through credit arrangements found themselves facing immediate insolvency because their lenders were bankrupt. But the economic impact extended far beyond individual financial losses. The collapse of Florence's banking system disrupted international trade relationships that had taken centuries to develop because there were no remaining institutions with the capital and expertise necessary to finance complex cross-border commercial transactions. Alessandro de' Bardi, who had begun the year as one of the most powerful financiers in Europe, ended it as a refugee from mob violence, hiding in a monastery while his family's palaces were looted and burned by depositors seeking revenge for their financial losses. He had lived to see the complete destruction of everything his family had built over 3 generations of careful wealth accumulation. The cascade was unstoppable now, and it was about to spread beyond Florence to threaten the economic foundation of medieval European civilization itself. Chapter 8. Bank Run. The morning of October 15, 1345, began like any other day at the Peruzzi Bank's marble headquarters on Florence's Via dei Bardi, until a breathless messenger arrived with news that would transform medieval Europe's second-largest financial institution into a battlefield within hours. Word had spread that the Peruzzi held substantial credit obligations from the now bankrupt Bardi Bank, and depositors were gathering in the streets outside, demanding immediate withdrawal of their funds before the institution collapsed like its rival. Donato de Peruzzi, the bank's managing partner, stood at his second-floor window watching the crowd grow larger and more agitated by the minute. These weren't just wealthy merchants and aristocrats who could absorb financial losses. These were shopkeepers, artisans, widows, and working families whose entire life savings were deposited with institutions they had trusted to preserve their modest wealth through professional financial management. You see, medieval banking operated on fundamentally different principles than modern financial institutions. Banks weren't just places to store money, they were the essential infrastructure that made commercial civilization possible in societies where most people couldn't read. Mathematical literacy was rare, and legal systems couldn't handle complex financial disputes. When banks failed, they didn't just destroy individual wealth, they destroyed the social trust that held economic relationships together. Here's what's fascinating. Donato understood the mathematics of bank runs better than most medieval financiers, having studied the accounting techniques that Italian bankers had developed to manage liquidity risks during temporary financial stress. He knew that the Peruzzi Bank held sufficient assets to honor all depositor obligations if withdrawals occurred at normal rates over reasonable time periods. The problem was that panic-driven mass withdrawals created artificial liquidity crises that could bankrupt even well-managed institutions. The irony was perfect and terrible. The Peruzzi Bank was actually in stronger financial condition than most of its competitors, having maintained more conservative lending practices and avoided the concentrated exposure to English royal debt that had destroyed the bardi. But their reputation for competence made them a target for depositors fleeing from less stable institutions, creating withdrawal pressures that were inversely related to their actual financial health. Look, this reveals something crucial about the psychology of financial panic during systemic crises. Rational individual decisions, withdrawing money from banks that might fail, produce collectively irrational outcomes that cause the very failures that individuals are trying to avoid. The people gathering outside the Peruzzi Bank weren't stupid or ignorant. They were responding rationally to information that made bank failure seem probable, but their rational responses were making that failure inevitable. Donato's first response was to implement crisis management procedures that the Peruzzi had developed after studying previous banking failures in other European cities. They would honor all withdrawal requests without question or delay, demonstrate their financial stability through transparent accounting, and provide detailed explanations of their risk management practices to restore depositor confidence through education rather than promises. This approach worked exactly as designed, for about 2 hours. The Peruzzi's transparent honesty about their financial condition reassured sophisticated depositors who understood banking operations, but it terrified unsophisticated depositors who interpreted complex explanations as evidence that the situation was too complicated to be safe. Financial sophistication that was designed to restore confidence actually increased panic among people who equated complexity with danger. Think about what this reveals about communication strategies during financial crises. The same information that reassures knowledgeable investors can increase panic among ordinary depositors who lack the technical background to evaluate complex financial explanations. Crisis communication requires different approaches for different audiences, but bank runs don't allow time for customized messaging strategies. The situation deteriorated rapidly when rumors began circulating that the Peruzzi had lent substantial amounts to the bardi and would face losses from bardi bankruptcy that weren't reflected in their public financial statements. These rumors were partially accurate. The Peruzzi did hold some bardi obligations, but they grossly exaggerated the scale and impact of those exposures in ways that made rational risk assessment impossible for most depositors. The mathematical reality was that Peruzzi losses from bardi bankruptcy would reduce their profits for several years, but wouldn't threaten their fundamental solvency or their ability to honor depositor obligations. The psychological reality was that any connection to the spectacular bardi failure was interpreted as evidence of fundamental mismanagement that made the Peruzzi equally untrustworthy as a custodian of other people's money. By midday, the crowd outside the Peruzzi Bank included over 2,000 people, representing millions of florins in potential withdrawals, far more money than any medieval financial institution could convert to cash without selling assets at distressed prices that would create the very losses that depositors feared. The bank was facing a classic liquidity crisis where short-term obligations exceeded liquid assets, even though long-term assets exceeded total obligations by comfortable margins. Donato's response revealed both the sophistication and the limitations of medieval financial crisis management. He negotiated emergency credit arrangements with banking institutions in other cities that weren't directly affected by the Florentine crisis, allowing the Peruzzi to maintain cash payments to depositors, while their illiquid assets were converted into money through orderly sales, rather than panic liquidations. These arrangements worked brilliantly from a technical standpoint, providing sufficient liquidity to meet withdrawal demands, while preserving asset values that would have been destroyed through forced sales. But they also created new vulnerabilities by making the Peruzzi dependent on continued cooperation from other banking institutions that were facing their own depositor panics as news of the Florentine crisis spread throughout Europe. Here's what's interesting. The Peruzzi's sophisticated crisis management techniques were actually accelerating the spread of banking panic to other cities and countries. Their emergency borrowing arrangements alerted foreign bankers to the severity of problems in Florence, causing precautionary measures that reduced credit availability throughout European financial networks. The psychological momentum became unstoppable when depositors began withdrawing money, not because they believed the Peruzzi was failing, but because they believed other depositors believed the Peruzzi was failing. This second-order thinking created withdrawal pressures that were completely disconnected from any rational assessment of the bank's financial condition or management capabilities. By evening, the Peruzzi had honored withdrawal requests totaling over 300,000 florins, roughly equivalent to the annual tax revenues of a medium-sized kingdom. They had demonstrated their liquidity and solvency beyond any reasonable doubt, but they had also exhausted their cash reserves and emergency credit arrangements, while facing continued withdrawal pressures that showed no signs of abating. The final blow came when news arrived that banking institutions in other Italian cities were refusing to extend additional credit to Florentine banks, citing concerns about the stability of the entire regional financial system. This credit market freezing meant that even well-managed banks couldn't access the emergency liquidity they needed to survive panic-driven withdrawal demands. Donato de Peruzzi faced the same impossible choice that had confronted Alessandro de Bardi just weeks earlier: suspend payments and acknowledge insolvency, or continue honoring withdrawals until the institution was completely destroyed. Unlike Alessandro, Donato chose transparency. On the evening of October 15th, he posted a public notice explaining that the Peruzzi Bank was suspending operations while restructuring their obligations to depositors and creditors. The announcement triggered immediate riots, as depositors realized that their life savings had been trapped inside a failed institution that might never reopen. The Peruzzi palaces were attacked by mobs seeking revenge. Documents were burned in the streets, and several banking family members were injured by crowds that held them personally responsible for the financial disaster. Within 48 hours, the contagion had spread to the Acciaiuoli Bank and 6 smaller Florentine financial institutions, creating a complete collapse of the city's banking system. Medieval Europe's financial capital had lost the institutions that made international commerce possible, and there were no mechanisms for restoring the credit relationships that supported economic activity throughout the continent. The bank run that had started as rational individual responses to localized financial problems had become a systemic crisis that threatened the foundation of European economic civilization. And it was about to get much worse. Chapter 9: Economic Collapse. By December 1345, the destruction of Florence's banking system had spread economic devastation across Europe with the inexorable logic of falling dominoes. Trade routes that had carried goods and wealth for centuries were abandoned because there were no financial institutions capable of providing the credit that made international commerce possible. Merchant families that had accumulated wealth over generations found themselves impoverished overnight when their banking relationships vanished. Entire cities that had built their prosperity on commercial activities faced economic collapse when the credit systems that supported their trade networks disappeared. The human cost was immediate and staggering. In Bruges, Flemish textile workers lost their jobs when Italian merchants could no longer finance wool purchases from English producers. In London, English wool producers couldn't sell their fleeces because there were no Italian buyers with access to credit. In Constantinople, Byzantine silk traders watched their inventory rot in warehouses because there were no Western European merchants with the financial resources to purchase luxury goods. You see, medieval Europe's economy had evolved into an interconnected system where local prosperity depended on international trade relationships that required sophisticated financial intermediation. When the Italian banks collapsed, they didn't just destroy individual wealth. They destroyed the credit infrastructure that made economic specialization and long-distance trade possible. Here's what's fascinating. Modern economists studying the 14th century crisis have identified it as the first recorded example of what we now call a credit crunch, when the failure of financial institutions creates economy-wide problems that can't be solved through individual business adjustments or governmental policy interventions. The Italian banking collapse had created a Europe-wide shortage of capital and credit that affected every aspect of economic activity. But the medieval world lacked the economic knowledge and institutional mechanisms that modern economies use to manage systemic financial crises. There were no central banks to provide emergency liquidity, no government stimulus programs to maintain employment during credit shortages, and no international coordination mechanisms to prevent localized problems from spreading across national borders. The immediate response was deflation, on a scale that medieval Europe had never experienced. When credit disappeared, the money supply contracted dramatically because most economic transactions had depended on various forms of debt and credit rather than physical currency. This deflation made existing debts more difficult to repay, creating additional business failures that accelerated the economic decline. Look, this deflationary spiral followed mathematical logic that wouldn't be fully understood until modern macroeconomic theory developed sophisticated models of how credit systems interact with price levels and economic activity. But medieval merchants and government officials could observe the effects even without understanding the underlying mechanisms. Prices were falling, economic activity was declining, and traditional policy responses weren't working. The agricultural sector, which employed over 80% of Europe's population, faced catastrophic disruptions when urban demand for food products collapsed, along with the commercial networks that had connected rural producers with city markets. Peasant farmers who had specialized in producing crops for urban consumption found themselves unable to sell their harvests at prices that covered production costs. This agricultural crisis created feedback loops that accelerated urban economic decline. When rural communities couldn't generate cash income from agricultural sales, they couldn't purchase manufactured goods from urban artisans, creating additional unemployment and business failures. In cities that were already struggling with the collapse of international trade networks, the political implications were equally severe. Medieval governments depended on tax revenues generated by commercial activity, and the economic collapse had devastated the tax base that supported royal administration, military expenditures, and public infrastructure maintenance. Kings and nobles who had borrowed heavily to finance military campaigns suddenly faced the dual crisis of falling revenues and rising debt service obligations. Consider what this meant for the stability of medieval European civilization. The same economic networks that had supported political centralization, military sophistication, and cultural development were now generating pressures that threatened to reverse centuries of progress toward more complex and prosperous social organizations. The most immediate political crisis developed in England, where Edward III faced the consequences of his debt default in ways that he hadn't anticipated when he repudiated his obligations to Italian bankers. The collapse of international credit markets meant that England couldn't access the financing necessary to continue military campaigns in France, effectively ending English imperial ambitions that had seemed unstoppable just 2 years earlier. But the domestic political impact was even more dangerous. English merchants and nobles who had invested their wealth with Italian banks faced financial ruin that threatened the social coalitions that supported Edward's reign. The king, who had seemed to strengthen England through military victories and international prestige, was now viewed as responsible for economic policies that had impoverished his most important political supporters. The crisis spread beyond Europe's traditional commercial centers to affect regions that had seemed insulated from Italian banking activities. Eastern European kingdoms that had developed commercial relationships with Florentine merchants found themselves cut off from the trade networks that had brought Western European goods and technologies into their territories. This commercial isolation forced previously interconnected regions to revert to more primitive economic arrangements based on local production and barter exchange rather than monetary transactions and credit relationships. The economic specialization and efficiency gains that had driven medieval Europe's economic development were being reversed by the collapse of the financial systems that had made complex commercial relationships possible. Here's what's interesting. The crisis revealed how dependent medieval European civilization had become on financial innovations that most people didn't understand and most governments couldn't control. The Italian bankers hadn't just provided convenient services, they had created the essential infrastructure that made economic growth and political development possible. The psychological impact was as devastating as the economic destruction. Merchants, artisans, and farmers who had believed that commercial development would provide increasing prosperity for future generations discovered that economic progress could reverse just as quickly as it had advanced. The optimism that had driven medieval Europe's commercial expansion was replaced by pessimism about the reliability of any economic arrangements that depended on complex financial relationships. Religious authorities interpreted the economic collapse as divine punishment for the moral corruption that they claimed was inherent in commercial activities and financial innovations. This religious response to the crisis created additional obstacles to economic recovery by discouraging the risk-taking and innovation that would be necessary to rebuild the credit systems that had been destroyed. By 1346, medieval Europe was experiencing what modern economists would recognize as a severe recession approaching depression conditions. Economic activity had contracted by an estimated 30 to 40% from pre-crisis levels. Unemployment was widespread in urban areas that had lost their commercial functions. Agricultural communities were reverting to subsistence farming as market-oriented production became unprofitable. The credit systems that had supported international trade, urban manufacturing, and agricultural specialization had essentially disappeared, forcing European economies to operate using primitive exchange mechanisms that couldn't support the population levels and living standards that commercial development had made possible. But the worst was yet to come. The economic collapse was about to encounter a biological catastrophe that would transform a severe financial crisis into the greatest demographic disaster in European history. The stage was set for medieval Europe's perfect storm, economic collapse combined with plague pandemic to create a civilizational crisis that would reshape the continent for centuries to come. Chapter 10: Systemic Failure. The final collapse of medieval Europe's financial system came not with dramatic announcements or violent riots, but with the quiet resignation of exhausted men who simply stopped showing up at banking houses that no longer served any economic function. By spring 1346, the Acciaiuoli Bank, the last major Florentine financial institution still attempting to operate, posted a handwritten notice on their locked doors informing depositors that economic conditions beyond our control have made continued operations impossible. With that simple announcement, medieval Europe's experiment with sophisticated international banking ended in complete systemic failure. The financial innovations that had taken 3 centuries to develop had been destroyed in less than 18 months, leaving behind economic devastation that affected every aspect of European civilization. Francesco Acciaiuoli, the bank's final managing partner, walked through Florence's empty financial district with the hollow-eyed despair of someone who had witnessed the collapse of an entire world. The marble palaces that had housed Europe's most powerful banking institutions were now abandoned ruins, their windows broken, their account books scattered by wind and rain, their safes empty except for worthless documents representing credits that would never be repaid. You see, the systemic failure of medieval banking wasn't just about individual institutions going bankrupt. It was about the complete breakdown of the trust relationships that made complex economic activities possible in societies where legal systems couldn't enforce long-distance commercial agreements and governmental authorities lacked the power to regulate financial activities. Here's what's fascinating. Modern economists studying the 14th century crisis have identified it as a textbook example of what complexity theorists call cascading system failure. When interconnected networks collapse in ways that can't be prevented through individual risk management or localized interventions. The Italian banks had created financial relationships so interconnected that the failure of any major institution inevitably triggered the failure of all other institutions. But medieval Europe lacked the theoretical frameworks needed to understand what was happening, or the institutional mechanisms needed to manage systemic crises. There were no economic theories that explained how credit systems interacted with broader economic activity. There were no policy tools that could restore confidence in failed financial institutions. There were no international cooperation mechanisms that could coordinate responses to cross-border financial crises. The immediate result was what modern economists call a liquidity trap, when the normal mechanisms that connect savings to investment break down completely, making economic recovery impossible through conventional business activities or policy interventions. Medieval Europe had abundant natural resources, skilled workers, and consumer demand, but it lacked the financial institutions necessary to organize these resources into productive economic activities. Look, this reveals something crucial about the role of financial systems in supporting economic complexity. The Italian banks hadn't just provided convenient services, they had created the essential infrastructure that made economic specialization, long-distance trade, and technological innovation possible. When that infrastructure collapsed, it forced European societies to revert to more primitive economic arrangements that couldn't support the population levels and living standards that commercial development had achieved. The human cost was immediate and overwhelming. Skilled artisans who had spent their lives mastering sophisticated crafts found themselves unemployed because there were no credit systems to finance the purchase of raw materials or the marketing of finished products. Merchants who had built international trading networks discovered that their expertise was worthless when there were no financial institutions capable of handling cross-border transactions. But the most devastating impact was psychological rather than material. Medieval Europeans had spent generations building commercial relationships based on mutual trust and reciprocal obligation, creating social bonds that extended far beyond immediate family and local community connections. The banking collapse had shattered these extended trust networks, leaving people isolated in ways that made economic cooperation difficult even at the local level. The political consequences were equally severe, but developed more slowly as the full implications of economic collapse became apparent to medieval rulers. Kings and nobles who had borrowed heavily from Italian banks suddenly faced the choice between honoring their debt obligations to bankrupt institutions or repudiating debts that could no longer be enforced through normal legal mechanisms. Think about what this meant for the fundamental legitimacy of medieval political authority. Monarchs had borrowed money based on promises to repay using future tax revenues, but the economic collapse had devastated the tax base that supported royal finances. Honoring debt obligations would require extracting resources from impoverished subjects who were already struggling to survive economic hardship. Repudiating debt obligations would establish precedents that would make future borrowing impossible. Most medieval rulers chose a middle path that satisfied nobody and solved nothing. They acknowledged their debt obligations in principle while indefinitely delaying actual payments, citing economic conditions that made immediate repayment impossible. This approach maintained the fiction of royal creditworthiness while providing no actual relief to creditors or clarity to potential future lenders. The breakdown of royal credit relationships had cascading effects on international political stability. Military campaigns that had depended on Italian financing were abandoned when credit became unavailable. Diplomatic relationships that had been cemented through financial partnerships dissolved when the banking institutions that had facilitated those partnerships collapsed. International law frameworks that had been developed to handle complex commercial disputes became irrelevant when there were no commercial relationships complex enough to require sophisticated legal resolution. By late 1346, medieval Europe had essentially reverted to the economic and political arrangements that had existed before the commercial revolution began 3 centuries earlier. Trade was conducted through barter and simple cash transactions. International relationships were managed through personal negotiations between rulers rather than through sophisticated diplomatic and financial institutions. Economic production was organized around local consumption rather than distant markets. But this reversion to simpler arrangements couldn't support the population levels and social complexity that commercial development had made possible. Medieval Europe in 1346 had approximately 25% more people than medieval Europe in 1000, but it was trying to support that larger population using economic systems that had been adequate for the smaller population 3 centuries earlier. This created what modern demographers recognize as a Malthusian crisis, when population levels exceed the carrying capacity of available economic systems, creating pressures that can only be resolved through population reduction, economic innovation, or social transformation. Medieval Europe was approaching this crisis when biological disaster struck in the form of the Black Death, which would kill approximately 1/3 of the European population between 1347 and 1351. Here's what's interesting. Many modern historians argue that the banking collapse actually worsened the demographic impact of the plague by destroying the economic networks that might have provided resources for public health responses or population support during the crisis. The financial catastrophe created social conditions that made biological catastrophe more deadly than it would have been under more stable economic circumstances. Francesco Acciaiuoli died in 1348, not from plague but from despair, having watched his life's work contribute to the destruction of medieval European civilization. His final letters describe a world where the bonds of trust that held Christian society together have been broken, and we know not how they might be restored. The systemic failure was complete. Medieval Europe's most sophisticated financial institutions had not just failed, they had demonstrated that financial innovation could be as destructive as it was creative, that international economic integration could amplify rather than reduce systemic risks, and that societies could become dependent on economic arrangements that they couldn't control or replace when those arrangements failed. The lesson would take centuries to learn and would be forgotten and relearned repeatedly as successive generations rediscovered the dangers of financial complexity that outpaced regulatory wisdom and risk management capabilities. Chapter 11. Medieval Depression. The decade following the banking collapse of 1345-1346 witnessed economic devastation that historians now recognize as medieval Europe's equivalent of the Great Depression. But unlike the 1930s crisis, which lasted less than 10 years and was eventually resolved through governmental intervention and monetary policy, medieval Europe's depression continued for over 50 years, fundamentally transforming European society in ways that would persist for centuries. By 1350, urban populations across Europe had declined by an estimated 40 to 60%, as cities lost the commercial functions that had supported their growth during the previous 3 centuries. Paris, London, Florence, and other major commercial centers became shadows of their former selves, with entire neighborhoods abandoned as residents fled to rural areas where subsistence agriculture provided more reliable survival than urban commercial activities. The demographic catastrophe wasn't caused only by plague. Economic collapse had already begun driving urban to rural migration before the Black Death arrived. When credit systems disappeared, cities lost their economic rationale because urban manufacturing and commerce required financial intermediation that was no longer available. People moved to the countryside not just to escape disease, but to escape economic systems that no longer functioned. You see, medieval cities had been essentially artificial creations that could only exist when sophisticated commercial networks provided food, raw materials, and markets that weren't available locally. When international trade collapsed, urban areas couldn't support their populations through local production, creating humanitarian crises that forced mass migration even without pandemic disease. Here's what's fascinating. The combined economic and demographic collapse created what modern economists call a deflationary death spiral. When declining population reduces economic demand, which reduces production, which reduces employment, which further reduces demand in self-reinforcing cycles that resist normal market corrections. This deflationary pressure made the few remaining debts increasingly difficult to repay, creating additional business failures that accelerated economic decline. A merchant who owed 100 florins in 1345 might find that the same nominal amount represented twice as much real purchasing power by 1355, making repayment impossible even if business conditions had remained stable. Look, medieval Europe was experiencing macroeconomic problems that wouldn't be properly understood until Keynesian economics developed sophisticated theories about how aggregate demand, employment, and price levels interact during severe economic contractions. But medieval merchants and government officials could observe the practical effects. Economic activity was declining, unemployment was widespread, and traditional solutions weren't working. The agricultural sector, which had initially seemed insulated from urban commercial collapse, soon faced its own version of systemic crisis. Peasant farmers who had specialized in producing crops for urban markets found that those markets had disappeared, but they couldn't easily convert to subsistence production because specialized commercial agriculture required different skills, tools, and land management techniques than subsistence farming. This agricultural transition problem was compounded by the demographic effects of plague, which killed experienced farmers while leaving their knowledge-dependent production techniques unused. Young people who might have learned traditional farming methods from their elders were instead struggling to survive in disrupted social environments where normal knowledge transmission had broken down. The result was agricultural productivity decline that persisted for generations after the immediate crisis had passed. Medieval Europe's agricultural output in 1400 was still substantially below 1340 levels, not because of continued population decline, but because the knowledge and social organization necessary for efficient agricultural production had been lost during the crisis period and couldn't be easily recovered. Consider what this reveals about the fragility of complex economic systems that depend on accumulated knowledge and social cooperation. The banking collapse hadn't just destroyed financial institutions, it had disrupted the educational and social processes that transmitted economic knowledge from one generation to the next. The political consequences were equally profound and longer-lasting than the immediate economic effects. Medieval governments that had borrowed heavily during the pre-crisis period faced chronic fiscal problems that couldn't be resolved through normal taxation because their tax base had been permanently damaged by economic and demographic collapse. This created what modern political scientists recognize as a legitimacy crisis, when governments can't provide basic services or honor their obligations, leading to questioning of fundamental political authority that goes beyond dissatisfaction with particular policies or leaders. Medieval monarchs who had seemed powerful and competent before the crisis appeared weak and incompetent when confronted with problems that exceeded their institutional capabilities. The breakdown of royal authority encouraged regional fragmentation and local autonomy movements that reversed centuries of progress toward political centralization. Nobles and local communities that had previously accepted royal authority began asserting independent control over their territories when central governments proved incapable of maintaining order or providing economic leadership during the crisis. But perhaps the most significant long-term impact was cultural and psychological. Medieval Europeans who had experienced the commercial revolution's promise of increasing prosperity and social mobility discovered that economic progress could reverse just as dramatically as it had advanced. This created deep skepticism about financial innovation and economic complexity that would influence European attitudes toward banking and commerce for centuries. Religious authorities encouraged this skepticism by interpreting the economic collapse as divine punishment for the moral corruption allegedly inherent in commercial activities and financial innovation. The Catholic Church's traditional hostility toward usury and profit-making was reinforced by the apparent demonstration that sophisticated financial practices led to social disaster. Here's what's interesting. This religious and cultural reaction against financial complexity created ideological obstacles to economic recovery that persisted long after the practical obstacles had been overcome. Even when political stability returned and population levels recovered, European societies remained suspicious of the banking innovations that would be necessary to restore international commercial networks. The technological impact was equally severe, but less visible. Medieval Europe had been experiencing significant technological innovation during the commercial expansion period, driven by urban craftsmen who had the resources and incentives to develop new production techniques. When urban commercial activities collapsed, technological innovation essentially stopped because there were no longer economic rewards for developing improved production methods. This technological stagnation meant that European economic recovery couldn't rely on productivity improvements that might have compensated for reduced population and disrupted social organization. Recovery required rebuilding the same economic relationships that had existed before the crisis, rather than developing more efficient arrangements that could support higher living standards with fewer resources. The international implications were profound and permanent. Medieval Europe's economic collapse occurred at the same time that other regions, particularly the Islamic world and East Asia, were maintaining or expanding their commercial activities. This relative decline reduced Europe's importance in international trade networks and diplomatic relationships in ways that would take centuries to reverse. By 1400, medieval Europe had essentially completed its transition from a period of economic expansion and innovation to a period of economic contraction and stagnation that historians call the late medieval crisis. Population levels wouldn't return to 1300 levels until the 16th century. Urban commercial activities wouldn't recover their pre-crisis sophistication until the Renaissance. Most importantly, European societies wouldn't redevelop the trust in financial institutions that would be necessary for economic modernization until the emergence of new banking systems during the early modern period. The medieval depression had ended not through recovery, but through adaptation to permanently reduced economic and social complexity. Europe had learned to survive with simpler economic arrangements, but it had also learned that financial innovation could be as destructive as it was beneficial, a lesson that would influence European economic development for centuries to come. Chapter 12. Banking Revolution. The Bardi banking collapse didn't just destroy medieval Europe's most sophisticated financial institutions, it accidentally created the intellectual and institutional foundations for modern banking by revealing the deadly flaws in medieval financial practices that future generations would spend centuries learning to avoid. The catastrophic failure of 14th-century Italian banks provided a brutal but comprehensive education in systemic risk, regulatory capture, moral hazard, and the dangers of financial innovation that outpaces institutional oversight. Every mistake the Bardi made, every risk they ignored, every warning sign they rationalized became a cautionary example that would guide the development of more stable financial systems. Lorenzo de' Medici, writing in 1469 as his family rebuilt Florentine banking from the ruins left by the Bardi collapse, explicitly referenced the earlier disaster as a guide for avoiding similar catastrophes. The Bardi taught us that banks can become too large to fail, but not too large to destroy everything when they do fail, he observed in letters that would become foundational texts for Renaissance banking theory. You see, the Medici banking innovations that would finance the Renaissance were direct responses to specific problems that had destroyed their 14th century predecessors, diversification strategies that limited exposure to any single borrower, geographic distribution that prevented localized crises from threatening entire institutions, conservative lending practices that prioritized capital preservation over maximum returns. Here's what's fascinating. Modern banking regulations that seem like recent innovations actually trace their intellectual origins back to lessons learned from medieval banking failures. Capital adequacy requirements, diversification standards, and limits on concentration risks all reflect principles that were first articulated by 15th century Italian bankers trying to avoid repeating the Bardi disaster. But the most important innovation was conceptual rather than practical. Medieval bankers had viewed their institutions as essentially private enterprises whose success or failure affected only their immediate stakeholders. The Bardi collapse revealed that large financial institutions were quasi-public utilities, whose failure could destroy entire economic systems, creating social responsibilities that transcended private profit motives. This insight led to the gradual development of banking as a regulated industry with public oversight, government supervision, and social obligations that balanced private profit with public stability. The concept of banking regulation, now taken for granted in modern financial systems, was invented by people trying to understand why medieval Europe's most sophisticated financial institutions had caused such widespread economic destruction. Look, this regulatory evolution took centuries to develop and involved repeated cycles of innovation, crisis, and reform that gradually created the institutional frameworks modern economies use to manage financial risks. But the intellectual foundation was established by analyzing the Bardi collapse and asking the crucial question: how can societies enjoy the benefits of financial innovation while avoiding the catastrophic risks that innovation can create. The geographical impact was equally profound. Florence's loss of financial dominance after the 14th century banking crisis created opportunities for other European cities to develop their own banking institutions based on improved understanding of financial risk management. Amsterdam, London, and eventually New York became major financial centers by avoiding the mistakes that had destroyed their medieval Italian predecessors. Each successive generation of financial centers learned from the failures of previous generations while developing new innovations that created new types of risks that wouldn't be fully understood until the next crisis revealed their dangers. Financial history became a series of experiments in risk management, with each experiment contributing knowledge that made future experiments slightly safer and more effective. Think about what this reveals about the evolutionary nature of financial innovation. The Bardi collapse wasn't just a historical disaster, it was a crucial step in the long process of learning how to create financial systems stable enough to support complex modern economies. Every banking regulation, every risk management technique, every institutional safeguard we take for granted was paid for with lessons learned from previous financial catastrophes. The intellectual influence extended beyond banking to influence broader economic thinking about the role of financial institutions in supporting social prosperity. Adam Smith's Wealth of Nations, published in 1776, explicitly discussed medieval banking failures as examples of how private vices could become public disasters when financial institutions grew large enough to affect entire societies. This insight contributed to the development of economic theories that balanced free market principles, with recognition that some economic activities required public oversight because their failure could generate social costs far exceeding any private benefits. Modern mixed economies that combine market mechanisms with regulatory oversight reflect intellectual frameworks that trace their origins back to medieval banking disasters. The technological implications were equally significant. The communication networks, accounting systems, and legal frameworks that Italian banks had developed for managing international commercial relationships survived their institutional collapse and provided the foundation for future technological innovations in financial services. Double-entry bookkeeping, letters of credit, and currency exchange mechanisms that the bardi had pioneered were preserved and refined by later generations of bankers who understood their value while avoiding the excessive risks that had destroyed their creators. Financial technology advanced through institutional failures that destroyed the organizations that had created the technology while preserving the knowledge for future use. Here's what's interesting. This pattern of technological preservation through institutional failure became a recurring theme in financial history. Each major banking crisis destroyed existing institutions while preserving the technological and intellectual innovations that could be applied more safely by their successors. The cultural impact was perhaps the most profound and long-lasting consequence of the medieval banking collapse. European societies developed what historians call financial skepticism, a deeply ingrained wariness of financial complexity and innovation that influenced economic behavior for centuries after the immediate crisis had passed. This skepticism served as a form of cultural immune system that provided some protection against future financial excesses while also creating obstacles to beneficial financial innovations. European societies became more conservative in their approach to banking and commerce, which reduced the risk of catastrophic failures while also limiting opportunities for rapid economic development. The balance between financial innovation and financial stability became a central theme in European economic thought, influencing everything from government policy to individual investment behavior. Medieval banking failures had demonstrated that financial innovation could be simultaneously beneficial and dangerous, creating permanent tension between the desire for economic progress and the need for economic security. By the time modern banking systems emerged during the 18th and 19th centuries, they incorporated risk management principles, regulatory frameworks, and institutional safeguards that reflected centuries of learning from medieval financial disasters. Central banks, deposit insurance, banking regulation, and international financial cooperation all evolved as responses to problems that were first revealed by the Bardi collapse. Today, when financial regulators discuss systemic risk, when central banks provide emergency liquidity during banking crises, when governments implement deposit insurance to prevent bank runs, they are applying lessons that trace their intellectual origins back to a desperate meeting in the Tower of London, where an English king and an Italian banker made decisions that accidentally destroyed medieval European civilization. The Bardi banking collapse stands as both a historical disaster and a crucial learning experience that shaped the development of modern financial systems. It demonstrated that financial innovation without adequate risk management could destroy entire civilizations, but it also provided the knowledge necessary to develop financial systems sophisticated enough to support the complex modern economies that medieval bankers could never have imagined. The revolution that began with the Bardi collapse continues today, as each generation of financial institutions learns from previous failures while creating new innovations that will be tested by future crises. The cycle of innovation, crisis, and reform that began in medieval Florence remains the fundamental process through which human societies learn to balance the benefits of financial complexity with the need for economic stability.